Today, let me talk about a very interesting concept called the Laffer Curve. Now, what is the Laffer Curve? And I'll also share a theory of mine, which I call as the lesser pain theory. Arthur Laffer is an American economist. He was at the Two Continents restaurant in the Washington Hotel talking to some advisors of the then President Gerald Ford in 1974. Gerald Ford was planning to hike up tax rates to increase revenue. And to illustrate the counter effects of that, he picked up a paper napkin and drew a graph like an inverted bell. And that came to be called as the Laffer Curve. Arthur Laffer himself says he didn't invent this concept. This concept is attributed to the 14th century Muslim scholar called Ibn Khaldun. More recently, it is attributed to John Maynard Keynes. But since Arthur Laffer is the one who illustrated it, it carried the name of Mr. Laffer. Now, what is this curve? This curve indicates that when governments raise tax rates, for a while tax collection goes up. And if you continue raising the rates, the tax collection actually comes down. As I said in the beginning, I have a similar theory. I call it the lesser pain theory. Now, what is the lesser pain theory? I've always said when people pay taxes, let's face it, it hurts. Doesn't matter how patriotic you are, I don't know a single person who pays tax and then comes home dancing, celebrating, I've done my national duty, it hurts. But folks, if you don't pay the taxes that you're supposed to and you get caught, the consequences also hurt. People will pay till such time that the pain of paying is lesser than the pain of the consequences of not paying. But when the government start raising tax rates, a stage comes where the tax rates become so high that the taxpayer says, listen, this is too much. I'll face the consequences if and when I'm caught, and therefore the tax collection starts going down. That means there is an optimum rate of tax beyond which it becomes counterproductive. It's an art how to identify that rate. Governments have to understand. What was the tax rate in India in the 60s? The highest marginal tax rate was 98%. If you earned more than 100,000 rupees. Very few people earn more than 100,000. But imagine somebody crosses the threshold of 100,000. What will happen? If the person knows for every rupee earned by me, 98 paisa has to be paid as income tax, first of all, his motivation to earn gets killed. Or number two, what will happen is he will earn the money and then he will not disclose, so it generated black money. It doesn't help anybody. Germany reduced tax rates, I think in the 60s or 70s, and the tax collection went up. India didn't have the courage to do so till 1991. When Dr. Manmohan Singh presented his first budget, the government had appointed a committee under the chairmanship of a gentleman called Raja Chellaiah. It was the Raja Chellaiah Committee on Direct Tax Reforms. Raja Chellaiah had submitted his first draft recommendations just before Dr. Manmohan Singh brought out his first budget. And Dr. Manmohan Singh incorporated almost all Raja Chellaiah's recommendations in the first budget itself. And one of the important recommendations of Raja Chellaiah were, India is in a high tax regime. We should reduce tax rates. From 98% in 60s, it had already come down to, if I'm not wrong, the corporate tax rate was 60% and the personal highest tax rate was 55% in 1991 when Dr. Manmohan Singh presented his first budget. And based on Raja Chellaiah's recommendation that we should reduce the rates, and Raja Chellaiah said, don't just reduce by 5% now. Go on, tell the people we will go on reducing and bring it down to as low as 30%. And that's exactly what happened in India. And guys, over the years, the tax collection has consistently gone up. So Laffer's curve says as the tax rates go up, the tax collection starts coming down. Now, during the Reagan presidency, the highest marginal tax rate in the US was 70%. And Ronald Reagan brought it down to 31%. And eventually the revenue continued to rise. Why I'm saying eventually is because the year in which he slashed the tax rates in order to raise collections, the collection had actually fallen. Ronald Reagan, guys, was a wonderful president of the US, an actor turned politician, but very fine person.
The story was an American and a Russian arguing about their two countries. And the American said, look, in my country, I can walk into the Oval Office, I can pound the president's desk and say, Mr. President, I don't like the way you're running our country. And the Russian said, I can do that. The American said, you can? He says, yes. I can go into the Kremlin to the General Secretary's office, pound his desk and say, Mr. General Secretary, I don't like the way President Reagan's running his country.
His economic thinking came to be dubbed as Reaganomics. You know, that's where the term was originally coined. Later on, this term has been used for almost everybody. Bushonomics and Manmohanomics and so on. But it was originally coined for Ronald Reagan. And it indicated his economic thinking. Even the US was going through a severe, every year they used to have massive budgetary deficits. And Ronald Reagan said, I'll be the first president to have tamed the budgetary deficit. So he had a plan. How do you reduce a budgetary deficit, guys? A budget has receipts and expenditures. When is there a deficit? When the expenditure is higher than receipts, right? So how do you reduce the deficit? Either your receipts should go up or your expenditure should come down, or both. So Ronald Reagan had a plan that he would work on both sides of the budget. He said on the expenditure front, he said US spends a lot of money on arms and ammunition. And he said, we have a massive stockpile. We don't need to spend all that. So he said, number one, I will propose slashing of defense expenditure. So the expenditure side will come down. And on the income side, he said, our tax rates are very, very high. So I want more collection. So I will reduce the tax rate based on the recommendation as illustrated by the Laffer curve. And he says, expenditure side will come down, income will grow, and I would have tamed the budgetary deficit. When Ronald Reagan got up to present the budget, the defense lobby was so strong that they did not permit him to cut even a single dollar. So he failed on that front. But he managed to push through his proposals for reduction of tax rates. And tax rates went down and tax collection went down because it takes time before it goes up. And in the interim period, the reverse happened. He wanted to tame the deficit, but that became a record high deficit. So that is but a story for another day.